In a 2007 interview, Warren Buffett expressed frustration in the US tax system, and that was because he was paying a lower tax rate than his secretary. So, what's going on here? Stick around to find out what Warren Buffett does to lower his tax rate and how you may be able to benefit from a lower tax rate strategy as well. Hi, I'm Nikki Andreessen with Oakley Financial Group, and today we're going to talk about how you can potentially lower your tax rate by creating more tax efficient retirement income, similar to how Warren Buffett lowers his overall tax rate. So, now when we think about Warren Buffett and why he has a lower tax rate than his secretary, the difference is most of Warren Buffett's income are dividends and long term capital gains, both of which are taxed at a more favorable, lower tax rate than ordinary income. So, as the secretary is paying income at ordinary rates that are higher, Warren Buffett is actually able to get out most of his income at a lower tax rate. And the question is, can the typical American take advantage of this strategy as well? And the answer is potentially. It depends on their asset mix. So let's take a little bit deeper dive into capital gains, their tax structure, and how it varies depending on the asset type. So before we get into the capital gains rates themselves, let's talk about what is a capital gain. Well, a capital gain is if you were to purchase an investment for, say, $100, and that $100 investment grew to $300. You have your $100 initial investment, you would have a $200 capital gain to get to your total $300 investment. Now, if you held that investment for over a year, it would be subject to long term capital gains rates. If you held it for under a year, it would be subject to short term capital gains rates. And long term capital gains rates are taxed at a more favorable tax tier of 0%, 15%, and 20%. Short term capital gains are taxed at your ordinary income rate. Now, remember when I'm talking about capital gains for the purposes of this video, we're really talking about capital gains within taxable accounts like your individual account, a joint account, a trust account, not within a Roth IRA or a traditional IRA or 401k, where all of those taxes are deferred. So you don't actually pay capital gains taxes within those retirement accounts. So this is really for individual accounts, joint accounts, and trust accounts. But within these accounts, if you have a long term capital gain, like I mentioned, it's a rate of 0%, 15%, and 20%. What a lot of people don't quite realize is that that 0% bracket goes fairly high from a taxable income perspective. So the chart you're looking at here is a chart that shows capital gains rates, long term capital gains rates, based on taxable income, based on filing status. So if we were to take a look at the 0% rate, we can see a single tax filer can pay a 0% rate up to $47,025 of taxable income. Someone who's married filing jointly can have long term capital gains rates at 0% up to $94,050 of taxable income. And remember, this is taxable income, not gross income. So if you have total gross income, you can actually take your standard deduction, which we have listed here for single and married filing jointly in 2024, to get down to your taxable income. So we have our gross income, we reduce by deductions, and that's how we get to our taxable income. So for married filing jointly, taxable income at 0% up to $94,050 is a high amount. And for the typical person, that can actually help keep them in that 0% rate for an extended period of time. Let's take a look at an example to really hit this point home. So we have Frank and Joanna. They are retired. They're age 65. Frank and Joanna have $1 million in company stock with a $500,000 basis. Now, Frank and Joanna are hypothetical clients. They might have their company stock with their basis, but you might have a diversified investment portfolio that has $1 million and it has a $500,000 basis. So when you're thinking about your own situation, doesn't have to be company stock. It can be a diversified portfolio. And remember, the stock market has really been in a run over the last 15 years. So the people we come across very frequently have high capital gains embedded in their investment portfolios. But back to Frank and Joanna, both qualify for Social Security. However, they're not currently taking it, so they don't have any Social Security income. They have retirement accounts of $2 million. However, they're not taking withdrawals. Remember, any withdrawals from a retirement account that's tax deferred and pre-tax, like an IRA or 401k or 403b, are taxed as ordinary income. They're not taking that. Frank and Joanna also need $10,000 per month for lifestyle expenses or $120,000 annually. So let's take a little bit deeper dive using our tax software to determine what is the best route for a tax efficient retirement income for Frank and Joanna, given the information that we have. We're going to go through a few examples. Let's take a look at a few different scenarios as far as how Frank and Joanna might be able to create a tax efficient retirement income stream, potentially reducing their taxes over the long term. So, the first scenario we're going to look at is, what if Frank and Joanna created their $120,000 of lifestyle needs, spending needs, by taking distributions or withdrawals out of their retirement accounts? So, in Frank and Joanna's situation, we assume that their $2 million of retirement accounts are pre tax 401ks, 403bs, IRAs, where any withdrawals out of those accounts would be taxed at their ordinary income tax rates. So, for Frank and Joanna to have $120,000 net after taxes that they could use for spending, they need to actually take out $135,000 out of these retirement withdrawals. So they take $135,000 out of their retirement accounts. They fall into the 22% federal marginal tax bracket. Their effective or average tax rate is 12.6%. So their total tax is $13,382. We take out $135,000. We pay a little over $13,000 in tax. So we have a little over $120,000 that's remaining for their lifestyle expenses. Looking at scenario two, we ask ourselves, is there a better option? And so, if they were to create this retirement income stream by using their taxable account, their company's stock, the $1 million that has the $500,000 of cost basis, which also means there's a $500,000 embedded capital gain, if they were to use that to create their lifestyle spending needs of $120,000, how might that affect from a tax standpoint? So remember, we needed $120,000, which means of that we sell to create that income stream, $60,000 is long-term capital gains. And remember, our capital gains rate for a married couple filing jointly goes all the way up to $94,050 of taxable income. Here we've got $60,000 of adjusted gross income. We're able to reduce by our standard deduction of $29,200. So their taxable income is only $30,800, which means their total tax is zero. They're able to create $120,000 of lifestyle spending needs by selling the company stock, and they've paid zero in federal taxes at the 0% long term capital gains bracket. So, this has been a really good scenario for Frank and Joanna. Taking it a step further and looking at a third scenario, really optimizing those long term capital gains and implementing a strategy we call long term capital gain harvesting. And long term capital gain harvesting is essentially taking the gains that we need and leveling all the way up so we fill up the 0% federal tax bracket for the long term capital gains. So, in their scenario, not only would we harvest $120,000 of total stock for the $60,000 of long term capital gains, we would sell more. We would sell more than we need and really kind of stock that up for future years. So, what do I mean by that? I mean, in their case, they would sell not $120,000, but potentially up to $246,500. And in that case, the long term capital gains would be $123,250. So by having long term capital gains of $123,250, again, we reduce it by our standard deduction of $29,200. $200. So their taxable income is $94,050, which is that magic number at the top of the 0% long-term capital gains bracket. So by harvesting additional dollars over and above what they even need, we're still able to pay $0 in federal tax and pay a 0%, long-term capital gains rate. But you might say, Nick, we didn't need all that money. And we still do it anyway because you take those additional dollars and know that we may need those in future years to continue to fund our lifestyle spending needs. And so we might sell more than we need. We put the proceeds in a diversified portfolio, which now has an adjusted cost basis where it's at on the date that we purchased it. And even if we really like the stock, the company stock in our Frank and Joanna example, we could buy that stock back. We would have to wait 31 days for something that's called a wash sale rule. But if we wait longer than 31 days, we can actually buy that very same stock back and get the capital gains treatment that we were intending to get. So it might be a really good option for Frank and Joanna. But I want to show you one final scenario. And really, when we're thinking about a tax efficient retirement income stream, there's multiple buckets for Frank and Joanna. So the question is, how do we get the most bang for our buck, not just this year, but long term over their entire retirement? Because we don't want to just focus on saving taxes today. We want to focus on saving taxes today and into the future. And what's going to have the largest cumulative effect on potentially reducing taxes over their life expectancy? So, scenario four, we actually do a combination of harvesting capital gains and making Roth conversions. And so when we look at Frank and Joanna's situation, we decided to make $29,200 in Roth conversions in this year. And that number is eerily similar to our standard deduction, as you might notice. That's intentional. We also harvest long-term capital gains of $94,050. So we have total income of $123,250, just like our last scenario, but it's made up of a different mix. It's now made up of both Roth conversions and long-term capital gains. So we have our adjusted gross income. We reduce it by our standard deduction. Our taxable income is our magic number of $94,050. And so our total tax on this is still zero. But the benefit of this over the last scenario is now we've converted IRA dollars to Roth dollars and paid 0% taxes on that and paid zero tax on that. We also were able to harvest our capital gains at the 0% rate for zero taxes on that as well. So, by the combination of these two, it potentially reduces their taxes over their entire retirement more so than the first few scenarios. And the reason it's important for Frank and Joanna is that Frank and Joanna, remember, have $2 million in retirement accounts. And those $2 million, by the time they hit their required minimum distribution age, may have grown. And at the required minimum distribution age, they're going to have to be forced to take distributions, which are going to be taxable. And if we're looking at longer term tax projections, we might see that they're in the 22 or 24 or even higher tax rate at that point. So we can convert Roth dollars at zero federal rate today, avoiding a potentially higher 22 or 24 or even higher rate in the future. That makes a lot of sense too. Now, harvesting capital gains at the 0% rate today also makes a lot of sense if in the future required minimum distributions, Social Security income, all of that pushes us into a higher capital gains rate where we might be in 15% in the future. So, in your particular situation, you really have to look at the different scenarios. Is it best to take out of your IRA? Is it best to take out of your taxable accounts where you may be able to harvest capital gains at 0%? Or is it best to do a combination of the two? And I'll tell you, for most people, it's typically a combination of the two, but it's really looking at your situation. Tax software really helps determine what is the optimal situation. So there you have it. How does Warren Buffett pay a lower tax rate than a secretary? It's the lower, more favorable long term capital gains rates. And if you have that option in your own portfolio to take advantage of the 0% long-term capital gains rate or even the 15% long-term capital gains rate, it may make a lot of sense to reduce your overall tax exposure as you work through retirement. But remember, always consult your tax advisor, your financial advisor when making these decisions. Because your situation is different from someone else's situation, and what might work for someone else might not work for you. So it's important that you consult your professional advisors to help you out with that. My name is Nick Andreessen, the Oakley Financial Group. I hope you found this insightful and provided a lot of value for you. If you want to learn more about us and how we work with our clients, go to www.oakleaffg.com. Thank you, and I hope you have a great day. Hi, everyone. One last thing. Please remember that this is for informational purposes only and meant to be educational. Any clients used in these examples are hypothetical clients. Please consult your tax, your legal, or your financial professionals before implementing any strategies that we discuss on these videos. Thank you, and I hope you have a great day.